Small caps, micro caps, and financials.
Don't rip through those charts because there's only 3, but there's a lot to say.
Vegas, baby. Vegas is on fire. Casino stocks. Hey, everybody. Welcome back to Pardon the Price Action. I am JC Peretz, and I am joined by Steven Straza. Steve, are you ready?
I'm ready, man.
For Laggards. There's always great information in the Laggards, particularly when it comes to analyzing downside risk. What are the weakest stocks, and what are they telling you?
Let's talk about first, what do you mean by that, right? What information in the Laggards? Why do we want to watch the weakest groups? We want to buy the leaders, right? Yes.
Well, I mean, if you're asking me, I think in bull markets, the laggards catch up to the leaders and you get rotation. I think that's why it's important. And in bear markets, the laggards continue lower and drag down the remaining leaders. That's why I think they're important.
Absolutely right. So we're watching the laggards because they're obviously most vulnerable. They're the worst areas, right? So if things like small caps or financials or even micro caps break lower and resolve lower from the ranges that they're in, a lot of these groups have pre-COVID highs or 2018 highs that they're also contending with, kind of similar to XLF. These will break down first, right? If we're going to see another leg lower for the broader market, these levels will all break. I'm watching micro caps extra close right now. IWC can scoop and score here and hold this 100 level. I think the rest of the market's going to be okay because this is really the worst group.
Yeah, and if they can't knock down the worst ones, what does that tell you about the market? Coming into the year, you saw a lot of weakness in growth and technology and things of that nature. And, they came into the year buying all of them, right? Right when they needed to. This is the same thing. Are they going to step up? Are they going to be buying these micro caps? Are they going to be buying financials, regional banks, small caps, the ones that are most vulnerable so that you get that rotation to the leadership groups? Is that what's coming? I think it is. And like you said, the risk is very well defined, 100 on the micro caps. I like that level a lot. It's a good one.
Yeah, we have some clean levels at least that we can look to, right? All right, perfect. Right on time. Look at that. Vegas, baby. Vegas is on fire, and casino stocks are the latest example of the market suggesting that the consumer economy is just fine. Are you ready to go all in on these hot stocks?
I mean, listen, you're seeing a lot of different consumer stocks doing well. You talk about those restaurant stocks. You could talk about home construction. These are all consumer discretionary names, and these are the same. Look at the VanEck Gaming ETF, BJK, making new 52-week highs as we speak. Look at Boyd Gaming pushing up against new highs. Las Vegas Sands, Wynn Resorts, DraftKings, one that you like very much. Not all, I guess you could say this SPAC was terrible and now it's on its way back. But, definitely a space that's intriguing. And by the way, on an equally weighted basis, consumer discretionary has been the best performer since the lows last summer. So definitely a part of the market that's front and center.
We continue to see these consumer stocks perform really well, whether it's, food, restaurants we've talked about, shoemakers, left and right. We're seeing whether it's Skechers or Deckers Outdoor make new highs. This is just that same theme, right? These are casinos. These are not the kinds of stocks that do well in a bear market or a recessionary environment, right? But they're pushing the new highs. I think that's really impressive. I will say, because the Kentucky Derby was on just this weekend, Churchill Downs, it's a racetrack, CHDN. I don't have it in the slide deck, but it's making new all-time high. It looks great. I would say, when a group is performing this well, if you go to the last chart, Penn National Gaming, when an industry group is, performing this well and you see the strong internals, which is all the charts you just went through, Las Vegas Sands, Wynn, all these stocks making new highs, please don't buy the ones that look like this, right? Don't go buying the laggards looking for some sort of catch-up trade. Typically, if you look different than the rest, everybody's moving higher, you're moving lower. There's a reason for that. Don't get cute. Stay away from Penn.
Yeah, there's the one that owns Barstool. It's pretty spectacular here, seeing how poorly it's performing, considering how well all the other ones are doing. And even something like a DraftKings, which is probably more comparable, not breaking down, actually breaking out. So what you're seeing in Penn Gaming is pretty disastrous, really, from a relative strength standpoint. I mean, it's just non-existent. I mean, this is as bad as it gets.
I agree. Something's going on there.
All right, Burger Bots. In this week's AI news, Wendy's just announced that it's working with Google to replace humans at the drive-thru with artificial intelligence. Are you bullish fast food stocks?
Well, it's hard not to be, right? If you just look at some of these charts. So we could look at Wendy's first. it's close. And I think this base eventually resolves higher. Why? Just look at some of the other bases. Look at the index itself, right? It's gonna follow the path of the rest of these. McDonald's new highs. You can go on down the line. And I'm just kind of bullish on the idea that robots are going to run the drive-through now. That's better for me. And I do like these stocks. I like the strength from these stocks. Wingstop is another big one. I also saw in the news today, Burger King is closing like 400 locations. So stock still looks okay. That would be restaurant brands. We didn't bring it along, but a lot of fast food news today.
Listen, you can add Yum Brands to this list as well, which is Taco Bell, KFC, and Pizza Hut, also making new highs. Big company there. But I got to tell you, on a completely another note, and I don't normally do this, but I got a beef. I was in Newark Airport over the last couple of days, and there's humans standing around watching you, but you got to like enter and you got to put your credit card, and it kept not working. And then I entered it 3 times. Then it took 40 minutes for the food. Everyone's just standing around chit-chatting because we don't need humans and the damn robots don't work. It was very, very frustrating. I did not like that experience at all. And I was trying to check out, it was kind of like you take the food and then like you use your credit card. There's no humans. The thing wasn't working either. I just did not have a good experience over the last couple of days with the non-human experience. I never thought that I would be that angry old guy yelling into the air, but I kind of like the humans. Like, hey, yo, can I get a burger and a beer? Like, why can't we just do it like that?
So I was in the airport a few weeks ago, and are you talking about one of the places you walk in, you swipe your card first, and then it lets you in, and then you kind of like take whatever you want and walk out, and it like knows what was in your hands?
This is a restaurant where I have to there's like a QR code like in the seat that I'm on. Like, it was ridiculous. It's a joke. We're moving on. Let's go. Healthy trends.
Yeah. Healthy trends. So healthcare stocks have been a real mixed bag this year. What stocks and groups do you like, and which ones are you staying away from?
Well, let's remember that healthcare represents 14% of the S&P 500. It represents 20% of the Dow Jones Industrial Average. So in America, this is one of the most important sectors for sure. And when you zoom out, you got these monster bases out of Merck, Pfizer, Bristol Myers. The thing is, one of these looks much different than the others. You're really seeing that strength in Merck for sure. Look at the difference here between the healthcare providers and the medical equipment. We talk about medical equipment like they're in healthcare, but at the end of the day, they're technology stocks. Like these are robots that are performing heart surgery and things like that. Like, it really is technology, and it behaves like technology. It behaves more like technology than it does healthcare, no? So just understand that there are different components to healthcare. It's hard to kind of just like blanket them all together, kind of like industrials, right? They got all kinds of different things going on.
It's probably, along with discretionary, the most diverse sector. Like you say, they're like tech stocks. Well, we're going to talk about tech during the 2-minute drill, and we're going to show you charts that look just like medical devices in the tech and growth space. But just to expand on some of the things you were saying, if you go back to the triple painter of Merck, Pfizer, and Bristol Myers, like, this is such a great example of what's going on in this sector right now. You really got to pick the winners, right? Because these are 3 big pharma companies. These are very close competitors. One's going up, resolved higher. One's stuck sideways, Bristol Myers, and the other one failed miserably. And if you go to that zoomed in chart of Pfizer towards the end down there, look at how different it looks from Merck on a short-term basis. Yeah.
Pfizer, Merck. Look at the difference. Nasty.
Yeah.
Nasty.
Pick the winners.
All right. Well, consumer staples have consistently outperformed for more than 3 months now. Is this defensive appetite something bulls should be worried about?
Why do we say that? I think this first chart explains that really well. This is basically showing you the S&P 500 relative to staples in the lower pane, and then the S&P 500 on an absolute basis up top in blue. These charts move in the same direction, and that's because we don't want defensive groups to lead. When defensive groups are actually lagging or underperforming, like staples in this instance, the market tends to do well. Same thing with discretionary versus staples. We need these ratios to start moving up and to the right to confirm the action at the index level. For me, I really think that like the level for this trend is if you look at this RHS RSP on the last slide, right? I'll start to worry more about this outperformance from staples that has been going on for so long if we take out the pivot highs here and get some sort of resolution.
Yeah, and one thing I'd like to add is that over time, consumer staples stocks tend to do well in an environment that the S&P is doing well, because at the end of the day, consumer staples are stocks also, right? And go back in time. They go up when the S&P 500 is going up because they're stocks. The difference is that when consumer staples are outperforming, that tends to come during a time that S&Ps are under pressure, and not every time, and it's not perfectly clean. And yes, you can go back to the 80s and everything like that. But from a rotation standpoint, if you're seeing consistent outperformance out of consumer staples, low volatility stocks in general, that tends to happen with stocks under pressure, not breaking out to new highs. So a breakout in staples on an equally weighted basis relative to S&Ps would definitely not be a feather in the hat for the bulls. It'd probably mean that more churning is necessary in the S&P, or perhaps even lower prices.
Yep, agreed. So this is a game that we like to play. I will say a word or phrase. You will tell me the first thing that comes to mind. Today's phrase is Berkshire.
When I think Berkshire, I think outperformance. One of the things that I looked up recently, I was doing a little homework, was that the NASDAQ 100, I believe, launched in either 1998 or 1999, QQQ, and then the SPY launched in 92, I believe, maybe 93. Yep. And since the launching of each of those ETFs, Berkshire Hathaway has outperformed each one through the end of last year, particularly the S&P. I think at this point, it's kind of equally, it's kind of matched up what the NASDAQ has done now, especially with the performance this year, because the NASDAQ caught up with a monster first quarter. But relative to the S&P, I think has more than doubled the return since SPY was launched. So when I think Berkshire Hathaway, think outperformance.
They're incredible. That they had their annual shareholder meeting this weekend, and Buffett and Charlie Munger, they still got it, man. Stuff they say up there, it's awesome to watch them on stage. It's just a really cool show that they put on. Go to the last slide, because when I hear Berkshire, I'm selfish. I'm thinking about our portfolio and our positions. I'm thinking Oxy all day, right? Oxy is really vulnerable here. It's in what we like to call the Buffett zone. We have annotated this chart to show exactly when and where Berkshire has been accumulating the stock over the trailing 15 months now. Do they step in, right? Do we see a 4 and 4 tomorrow, or do they not step in and this distribution pattern or potential top finally completes and resolves lower? I think we get our answer soon.
Yeah, definitely. Interesting. All right. Well, 2-minute drill. We got the old banks and big cap tech. Banks are down roughly 40% just in a matter of a few months. Meanwhile, the NASDAQ 100 is up about 25% on the year. How long can this divergence last? Who's right here?
The longer it does last, I keep thinking to myself, the broader market is right. In fact, the longer that this goes on, because it's been, like you said, several months now, with where these groups are literally moving in opposite directions, with momentum, you could argue, right? I'm starting to question, do we even need banks? Something we've said for a long time is you can't have a real bull market without the banks. Do we need to rethink that? I don't know. Is that still true? Are we going to have a bull market without the banks right now? The longer the broader market holds up, the longer I think that banks eventually do catch higher to the NASDAQ. And the big levels we're watching, like if you go to the XLF chart here, the big levels that we're watching for financials are still intact. And also the Russell and microcaps, like we discussed at the top of the call.
Listen, as far as do these banks matter or do they not? I think the biggest ones do. The JP Morgans of the world. I think that's what the market is focused on. It clearly does not care about these tiny little market cap banks disappearing. What's the number? 1,400, 1,500 banks? What's a couple disappearing due to this market? Clearly nothing. So the question really becomes like, is this, the canary in the coal mine and there's more to come? Is this, what do they say? The first domino, there's more dominoes. There's not just one cockroach, right? All of these things that they say, is that what it is? Well, if it is, and things are going to get progressively worse, you're going to see financials, the ones that actually do matter. These are the mega cap bank stocks. These are the ones that really do matter to the financial system. If they're breaking back below 30, getting back below the great financial crisis highs, now we could start talking, all right, Straza, that's a big break. What are they pricing in? What's coming on the horizon? What's going on? It's not these, billion-dollar banks disappearing left and right. Like, clearly the market does not care. And by the way, maybe the market doesn't care if these big banks start to fall, but my bet is that they will, right? Is my bet.
I would think they will. And let's be careful here, right? Like, let's also focus on the positives. While it makes sense to be cautious because of the price action from financials, let's not ignore all of the bullish developments. It's not just growth. It's not just these mega cap stocks, holding up the market. Sure, we have these great reversal patterns in tech and communications, but go to some of these other groups, right? We just talked about casinos. You got that reversal pattern. We talked about medical devices. You got that reversal pattern. Home builders are up 60% from their lows last year. So it's not just growth. We also can point to some very offensive areas and say, hey, why are they doing so well too? So we will see. We'll find out soon. Hot takes.
What do you got?
I was up in your neck of the woods, your old stomping ground in Miami the other night. Went to the Knicks Heat game.
I like how you say up in your old neck of the woods, right? Very few people go up to Miami.
I do. I go up to Miami. Traffic was horrendous, but I made it to the game. The game was great.
What game did you go to? Tell the folks what game you went to.
I went to the Heat Knicks game. I think the series was 2-1. The Heat won. Now they're up 3-1. I think they could close it out tonight. But dude, they could really shoot, huh? I mean, they did not miss. Maybe a little bit in the fourth quarter, but they were on fire.
The knock on the Heat was that they weren't as deep as the Knicks bench. Clearly, it's the exact opposite. The Heat are the ones with the crazy bench, and the Knicks have nothing. And at the end of the day, the Knicks just don't have a closer, right? I mean, that's really important, particularly in playoff time. Like when it's winning time, you need a winner that's just a killer, and the Knicks just don't have that guy.
Like you said, also, like, we're not deep either. Like, I don't know much about the Knicks anymore. That's what 20 years of losing will do to a fan. But it's two guys, it's Brunson and Randle.
This is the best team you guys have had in 24 years.
That was exciting. Let me just say, though, as much as I love Madison Square Garden, what a delight to go to a basketball game on the ocean. Like, that's just a beautiful arena. No FTX arena, but lovely place. Had a lot of fun.
Yeah, I've traveled around the country, around the world, different stadiums and arenas and, concerts and hockey and all sorts of stuff. And I'm not being biased here. Miami Arena is just a great arena. They do a really nice job there. They put on a great show. It's a great party, good eats. Totally, 100%. Madison Square Garden has its own charm for other reasons, but then you walk outside and, you smell like a hungry homeless man. Who hasn't showered in 2 weeks. Like, it's not exactly the nicest part of town. So Miami basketball is winning in a couple of ways, more ways than one. All right, here's my hot take. Big shout out to the NAAIM, the National Association of Active Investment Managers. They flew me out to Arizona, and I was down there for a couple of days, hung out with Andrew Thrasher, had lunch with him, had dinner with our friend Howard Lindzon. And then the folks at the NAIM, just great folks. These are financial advisors from anywhere from 10 million to 10 billion in assets under management. Really, really cool. I started the presentation by asking everybody if they thought we were in a bear market or a bull market, raise their hand. Almost all of them said that we were in a bear market. I asked, okay, do you think S&P's close higher or lower at the end of the year from where we are? Almost all of them said lower. And I then went on to present with 180 slides explaining to them how I think it's the exact opposite of that outcome. And they took it well. So shout out to the NAIM. Thanks for the invite.
So you basically went to meet the humans that are behind this poll data that we pay so much attention to.
Yep. And then I showed them how we plotted and stuff like that. And yeah. So these are the actual humans. And it's exactly what you think they are. They're a bunch of financial advisors trying to learn. They had an attorney helping with the compliance questions. They had issues, some of them custody at TD, and now with the merger with Schwab, it's like a whole thing because they like the technology in TD, and it's like financial advisor problems. Like, right, I don't care about any of that stuff, but I can appreciate that they do. And I'm like, listen, you guys have had a ton of presenters talking about all kinds of different topics. Me, I'm here to talk about the markets, right? Let's go. And they liked it. I came right after the compliance guy, so I had to have been a better presentation than that.
They teed you up nice. There you go.
I think they teed me up nice. Yeah. So, all right, guys, listen, appreciate it. Straza, everybody, thank you for watching. Make sure to give us a like and hit the subscribe button so you never miss an update. And follow me at All-Star Charts on Twitter. Make sure to follow Steve at S Straza. Leave a comment below. Let us know what you think, and we will see you next week.